Back as we study market-based approaches to value private companies. We'll learn the guideline public company method, guideline transactions method, and prior transaction method. Let's dive right in. As mentioned in the previous lesson, many valuators prefer market approaches to valuation over the other two approaches because actual transaction data are used. This is also the preferred method of valuation acceptable to US tax courts. We shall discuss three methods that are classified as market-based approaches: the guideline public company method, the guideline transactions method, and the prior transaction method. The guideline public company method is based on the observed multiples from market trades of comparable public companies. The guideline transactions method is based on pricing multiples derived from the acquisition of entire public or private companies in the past. Whereas GPCM uses a multiple that could be associated with trades of any size, GTM uses a multiple that specifically relates to sales of entire companies. In either method, if multiples from public companies are used, they should be adjusted to reflect differences in the relative risk and growth prospects against the subject private company. The prior transaction method considers actual past transactions in the stock of the subject private company. The actual price paid for shares or the pricing multiples implied by past transactions in the stock can be used for this method. Regardless of the method, multiples are used to value the private company. Unlike valuation for public companies, where price multiples like PE and PB are often used, the choice of an appropriate multiple for the private company valuation requires substantially more thought. For larger companies, valuation is usually based on EBIT or EBITDA multiples. The market value of invested capital, which is the market value of equity plus the market value of debt, is often used as the numerator. For example, if a guideline public company's MVIC over EBIT multiple is 10 times and the risk adjustment is 25%, the private company should be valued at 7.5 times multiple. So if the subject private company has an EBIT of $1 million, its MVIC should be valued at $7.5 million. So to estimate the value of its equity, we first need to know what is the market value of its debt. If the market value of debt is hard to ascertain, the book value can be used if the firm has low financial leverage and is stable. If the firm has high debt levels or volatility, an analyst could use matrix pricing, where the prices of similar debt are used to infer a value for the subject's debt. You've learned matrix pricing in Level 1. So for illustration, if the book value of the private company's debt is $0.5 million, its equity should be valued at $7 million. For small private companies with limited assets, net income multiples might be used instead of EBIT multiples. A revenue multiple might be used for extremely small firms, given the greater likelihood of discretionary expenses such as owner compensation. Specific non-financial multiples may be appropriate in some industries. For example, a hospital's price per bed could be used. These measures should be accepted in its industry and accompanied by financial measures. Besides choosing an appropriate multiple, the valuator also has to choose appropriate comparables. Commonalities in industry, operations, size, and life cycle are desired. Even for prior transactions, such commonalities are important, so the prior transaction should be at least fairly recent, such that not much of the fundamentals have changed. For guideline public company method, one unique consideration is the issue of control. Multiples based on market data is usually from the perspective of minority shareholders with no control of the company. In contrast, investments in private companies often include the element of control, so a control premium may be warranted in such cases. The control premium equals the difference between the pro rata value of a controlling interest and the pro rata value of a non-controlling interest. Historically, a control premium can be estimated from past acquisitions of comparable public companies. For example, if there was a recent acquisition of a public company at a stock price of $130, but the stocks were trading at just $100 before the acquisition, the control premium is estimated to be 30%. However, when estimating a control premium, the following issues should be considered. First, the type of transaction. A transaction may be either strategic, where the buyer is motivated due to synergies with the target, or non-strategic, where the buyer is one who is buying the firm for its standalone value. A strategic buyer will typically pay a higher price premium. Industry conditions should also be considered. Periodically, there is a flurry in industry acquisition activity, driving up acquisition prices. In such markets, share prices of public companies may already reflect some element of control premium, so adding a standard control premium to such share prices may overstate the appropriate premium for control. the form of consideration for payment is also an important factor. If the past transactions involve significant exchange of stock, the analyst may need to investigate if the acquirer's stock price was overvalued in the first place. Now let's go back to our earlier example where the multiple for comparable public company is 10 times, and after a 25% adjustment for the company risk, the justified multiple for the private company is 7.5 times. And if EBIT was $1 million, MVIC would be $7.5 million. If market value of debt is $0.5 million, market value of equity should be $7 million. This is before any control premium is considered. And let's say a control premium of 30% is appropriate. This would bring up the value of the private firm's equity to $9.1 million. Note that the control premium should only be applied to the firm's equity value, not total capital value. This is the amount the acquirer should pay to buy up all the shares of the company. In terms of multiple, the acquirer is paying an MVIC over EBIT multiple of 9.6 times. Let's pause for some practice. A private equity fund wants to acquire LunaShop, a privately owned pharmacy chain. Comparable public traded pharmacy stocks trade at an average MVIC over EBITDA multiple of 6 times. However, LunaShop is a comparatively smaller chain, so the PE fund analyst has estimated a 10% discount to account for the higher risk. SolarShop was a public listed pharmacy chain that was recently acquired by an industry rival at a premium of 25% over its last traded stock price. The acquirer exchanged stock for SolarShop. Determine an appropriate control premium for the PE fund to acquire LunaShop. Pause the video now and work out your answer. And we're back. Let's first consider the differences between the acquisition of LunaShop and SolarShop. It's not explicitly stated, but it is safe to assume that most PE funds acquire companies using cash. Also, the PE fund is most likely a non-strategic buyer, as it is buying for financial gains. For SolarShop, however, we're told that the transaction was paid using shares. We're also told that the acquirer was an industry rival, so it's likely a strategic acquisition. So, given these differences, the control premium of 25% for SolarShop is probably not relevant for the valuation of LunaShop. Also, as the PE fund is most likely a non-strategic buyer, a control premium may not be relevant at all. Since the acquisition of SolarShop is not comparable to that of LunaShop, and that the PE fund is a non-strategic buyer, a control premium may not be appropriate for the acquisition of LunaShop. Next, given the following data on LunaShop, estimate the company's equity value using the GPCM method. Pause the video now and work out your answer. And we're back. Let's first calculate the adjusted multiple to apply for the calculation. Since we're told that the multiple for the guideline public companies is 6 times, and that a 10% discount is warranted to account for the higher risk, the adjusted multiple should be 5.4 times. And given that LunaShop's EBITDA is $10 million, and the adjusted multiple of 5.4, its MVIC should be $54 million. We're not given the market value of debt for LunaShop, but we know that the book value is $5 million. Since this amount is low, we can just make the assumption that this is the market value as well. Subtract this from MVIC, the equity value of LunaShop should be $49 million. So we've learnt that adjustment for controlling interest should be applied to the guideline public company method if appropriate. But how about the guideline transactions method? If you think about it, the GTM method compares against acquisitions of entire comparable companies, so the acquisition price should have already incorporated control premium. As such, control premium should not be added again for GTM. However, there are other issues that the valuator should consider when using the GTM method. First, consider if the transactions are strategic or non-strategic. Appropriate adjustments need to be made if there are significant differences in anticipated difference in synergies. The type of consideration. As noted previously, some transactions are for stock rather than cash. In some cases, using stock-based transactions to value cash-based transactions may not be appropriate. Contingent consideration refers to a part of the acquisition price that is contingent on the achievement of specific company performance targets, such as receiving FDA approval for a drug. Such transactions should be scrutinized for their comparability against transactions without such contingencies. The availability and recency of data. The historical data for comparable acquisitions that are relevant and accurate may be limited, and even if available, they may be outdated data which are no longer relevant due to macroeconomic and industry changes. And let's practice the GTM method. Going back to our last example on the valuation of LunarShop, let's say the PE fund wishes to use the GTM method to value LunarShop. PlutoShop, another private pharmacy chain, was recently fully acquired by an institutional investor for $70 million in cash. Given the following data from PlutoShop before its acquisition, estimate LunarShop's equity value using the GTM method. Pause the video now and work out your answer. And we're back. First, let's make some considerations as to whether the PlutoShop transaction is comparable and if any adjustment is needed. First, it seems that PlutoShop is slightly larger than LunarShop, and the proportion of leverage is higher too. However, they're not significantly different, so no size or risk adjustment is warranted. We're told PlutoShop was acquired for cash, and that it was also privately owned before acquisition. It was acquired by an institutional investor, so it is likely non-strategic. As such, the transaction is very much similar to LunarShop, so it is an appropriate guideline transaction without any required adjustment. Before we calculate the multiples, we will make the assumption that the market value of debt for both companies are equal to their book values. The MVIC for PlutoShop is $70 million plus $10 million debt. The market value of its equity is $70 million because that is what the acquirer paid for the shares. Divide by the EBITDA of $16 million, we get a multiple of 5 times. And using this multiple without adjustment, multiply by LunarShop's EBIT of $10 million, we get an MVIC of $50 million. Subtract $5 million of debt, we get equity value of $45 million for LunarShop. Incidentally, this is the same as its book value. And to wrap up, let us briefly discuss the prior transaction method, which considers actual transactions in the stock of the subject company. Valuation can be based on either the actual price paid or the multiples implied from the transaction. The obvious limitation of this method is that there could be little or no past transactions in the private company's stock. However, if such transactions are available and are made at arm's length, meaning that neither buyer nor seller were compelled, the PTM method would be expected to provide the most meaningful evidence of value. When using this method, it is important to set into context the material changes that have occurred since the reference transaction. For example, if the company was awarded a significant patent after the transaction, the value of its stock or multiple may need to be upwardly adjusted. And that concludes this lesson on the market-based approaches to valuing private companies. In the next lesson, we'll touch on the asset-based approach. See you again.